Ask Annex, joined in the studio by Sarah Kyle, Wealth Manager at Annex Wealth Management. Welcome.
Hi, Danny.
Matt Morzy is Investment Team Manager and a CFP at Annex Wealth Management. Welcome to you.
Hey, Danny.
Got a bunch. And folks, here's how it goes. If you got a question for us, wide open, head to our website, annexwealth.com. Look for the Ask tab. Don't have to be a client. We get back to everybody. Some wind up on the radio, like this one from Kyle. Can you please explain how a stable value fund works?
Yeah, it's a lot more complicated than I even thought going into it. So stable value fund is something that's only going to be found in CIT structure. So it's not an ETF or a mutual fund, and it's only an ERISA type plan. So if you think a 401k, not going to be available in an IRA or taxable account would be the easy way to think of that. And it's generally considered to be like the cash or the stable part of a portfolio, but it's a little bit more detailed than that. So the goal there is to provide a return that's greater than your money market, but with the same stability. So essentially it's a basket of bonds or fixed income, but they use insurance contracts in order to stabilize the price of it. So they're able to get a higher yield, but protect that there's no principal fluctuation through there. So a couple things to think of from that standpoint is you're going to get a better yield than a money market in most situations. The other thing is that money markets reset their prices more frequently. So in a rising rate environment that we've had now, money markets probably are paying more than your stable value is, but that should catch up over time. Second to think of is your 401k administrator. There are some rules around that. So when you think of that, if you're going to move from one provider to another, you might have some money locked up or additional fees you might have to pay in order to move that. So it ends up being pretty complicated, but I would think of it as a higher yielding money market. Same principle, stability, but a generally higher yield.
Next up is from Stu. Are mutual fund and ETF returns shown before or after fees?
Well, generally mutual funds will show the return net of fees, but you can see it both ways because every share class has a different fee structure.
Yeah, and I think that's really important to remember is that performance is generally going to be shown after fees. So although fee is extremely important and study after study shows that you want to keep fees as low as possible for better long-term results, that sometimes it's worth paying that fee. You do get what you pay for sometimes. So just picking based off of that fee is going to be a little bit short when it comes to that overall return.
Yeah, and a lot of times when you say you get what you paid for, expense ratio fee could be over 1%, but if that mutual fund manager is generating a lot of alpha, like you said, you get what you pay for and it's worth that fee.
Yeah, and certainly another thing to think about too is that you might have two ETFs that are tracking the same index, but you might have a different fee. So that's when it really is important because you really are paying for the same thing. You want to take the lower cost option there.
Yeah, and you also want to see where he is in relations to his peers, right? If he's number 80 out of 100 in his share class on performance, I don't know if that larger fee is worth it.
Which leads us to an anonymous question. How key to the success of an ETF or mutual fund is the manager? Have you ever exited a fund because of change in leadership?
Yeah, I think it's certainly vital. Recently, we haven't left any funds because a manager changed, but we haven't had that situation come up. To us, where it becomes a little bit more important is that we oftentimes will pick a fund because of who the manager is. And one thing that we like to do is follow a manager from one place to another. So a lot of times you'll have a manager have a lot of success at one firm. The fund gets really, really large and they become less nimble and able to put their strategy out there. So what they'll do is they'll either leave and start their own company, their own fund company, or they'll get recruited away to go to someplace else. And a lot of times we'll wait for them to do that and then invest with them at the new fund because they start off with a smaller dollar amount. They're more nimble. They're really able to execute their strategy. So we'll oftentimes follow a manager from one place to another, but also you want to look at what analysts that they have too. If you had an analyst that left, maybe you're the same overall manager, but maybe that was the key. Their success was that specific analyst.
And that's the advantage of having an active management team. We do all that research for you. So all those prospectuses that you guys are throwing in the garbage, we're reading. And so that's where we find out if there's a mutual fund manager change. And that's what we do when we're researching it and really vetting our managers that we follow.
How did you know that I don't curl up with that 35-page document?
I just had a feeling, Danny.
All right. Next up from Harold, when do I need to buy a stock to get its dividend? Anything I need to watch for?
Yeah, so there's a couple of main dates when it comes to dividend payouts. So one is called an ex-dividend date, and then the other main one would be the pay date. So real simple, pay date is the day that you get that dividend. The ex-dividend is key, though, because it's when they figure out who is going to receive the dividend or not. And one thing to remember is that, so if the ex-dividend date for a stock is today, you had to buy that stock yesterday in order to get that dividend. Key thing to think about, though, on that ex-dividend date, because now they know who's going to get that dividend, the share price of that stock actually reduces by the amount of the dividend overnight in order to take into account that the dividend is going to be leaving. Think of it this way. The stock price goes down because now the company's worth a little bit less because that cash that they had, which was part of that company worth, they're about to send out to somebody else. So if you buy before the ex-dividend, you pay a little higher price, but you get the dividend. If you buy that on the ex-dividend date, lower price to buy it, but no dividend.